Hello guys, welcome to another video. It's Kumoya, your mentor. So today we're going to be doing how to master market psychology, right? We all know that psychology is a very critical aspect of trading. You need to really master your psychology in order to be a very successful trader, right? So let's dive into market psychology. It's lesson 1. This is the simple Forex PDF. So if you want the PDF, just hit me up and then I'll hook you up with the PDF. You can check the prices on our website. You can just go to the link tree in the bio, in the Instagram bio, and go to the website and then check the prices for the PDF. So let's start, guys. So first of all, we're going to start with the importance of market psychology, right? As a trader, you need to understand that Forex is 80% psychology and 20% strategy. You can be the most skilled and accurate trader of all, but if you have not mastered the psychological side of foreign exchange, then you're hopeless. Mastering your mindset is the first step you need to take to become a successful trader. This module will take you through all the steps you need to take to master your mindset. Read this module clearly and carefully, and you will certainly be equipped with a firm trading mindset, right? So guys, let's start. We're going to start with what emotions to avoid when trading. Impatience. Impatience can cause traders to act impulsively, resulting in entering trades prematurely or closing trades too early. It can also lead to overtrading, where traders execute trades excessively, driven by a desire for constant action. So this last, driven by a desire for constant action, most traders get very bored, and one thing they don't realize is that trading is a very patient thing. It's a very patient game because you have to wait for the trade or for the market to come to you. So sometimes it can be very, very boring, and then you're just looking at the market, waiting for the market to come to you. So sometimes you can just take trades impulsively, maybe looking for some action, or that trading rush. Everyone knows that trading rush, looking for that trading rush, right? So the second thing is greed. Greed can cloud judgment and lead traders to take excessive risk in pursuit of larger profits. It may result in holding on to losing positions for too long or entering trades without proper analysis or risk management. We all know greed, guys. Sometimes you guys get greedy, and I know I do this too. You're not alone. Sometimes you get very greedy, and then you take these impulsive decisions, and then you increase your lot size in pursuit of having larger profits, or in pursuit of having more money in your portfolio, right? And then the third emotion to avoid is overconfidence. Overconfidence can make traders underestimate market risks and overestimate their own abilities. It can lead to reckless trading, failure to properly analyze the market, and neglecting risk management practices, right? So sometimes you guys get very, very confident and think that you are all knowing, especially when you're within a winning streak. Let's say you are like from Monday to Thursday, you're in a winning streak. Now Friday comes, you increase your lot size, you say, you know what, I've been trading this certain strategy for this long, so I know I can't lose. Like, I've been winning for the past 4 days, so I'm going to risk more, and then I'm going to take these trades because I know that the previous days I've been winning. And then that day you get a down draw, and then you lose half of your account, or even worse, you lose all of your money in your portfolio, right? So you must really avoid that overconfidence. The fourth thing is revenge. Revenge trading occurs when a trader tries to recoup losses by taking high risk trades or deviating from their trading strategy. It often leads to emotional decisions and further losses. Sometimes people get emotional when they are in losses, and then they start acting impulsively to try to recuperate those losses, and then it leads to more losses. So if you know that in your trading plan you have set out a plan that you're only going to lose 10% of your account in one trading day, or 5% of your account in one trading day, then if you lose that, you can just step away from the market and leave and just take a break until the next day, because you're going to take emotional decisions trying to recoup those losses that you took, and then it's only going to lead to more losses, right? The fifth thing is fear. Fear can lead to hesitancy and indecision. causing traders to miss out on profitable opportunities or exit trades prematurely. It can also lead to overcaution and the avoidance of necessary risks. So sometimes people fear, but I think mainly why people have fear in the market sometimes is that they have lack of risk management practices. If you know that in this certain trade or in these trades I'm only going to lose 5% of my account or 10% of my account, then you have nothing to fear. You can enter those trades, and then have no fear at all. But if you want to risk all of your account and then not use any stop losses, obviously you're gonna have fear. You're gonna hesitate. You're gonna make unnecessary decisions or decisions that might affect your account, right? So fear, it can only be fixed by you using risk management practices and knowing that, okay, I'm going to only lose this amount of money when I trade, right? So then you have no fear because you know you're in the safe zone, right? So risk management is also a crucial part. If you are having fear, you must really try to understand how much money do you risk, or what is your risk practices in order to tackle this emotion, right? And then successful traders work on developing emotional discipline and maintaining a calm and rational mindset while trading. They understand the impact of emotions on their decision making and take steps to avoid being influenced by them, right? So that's the end of how to master your emotions, or what emotions to avoid, right? So you should always look into your emotions, because emotions are really what might affect your portfolio in times, right? So then we're gonna dive into the next phase. The next key point is characteristics of a successful trader, right? What characteristics does a successful or consistent trader possess, right? The first thing is emotional control. Successful traders possess emotional control and avoid making decisions based on fear and greed. You remember the emotions, fear and greed. They understand that emotions can cloud judgment and lead to irrational trading decisions. They maintain a calm and rational mindset even during periods of market volatility or unexpected events, right? The second thing they possess is that they have discipline and they are patient. Successful traders follow a disciplined approach and adhere to their trading strategies. They have the patience to wait for the right trading opportunities and avoid making impulsive decisions. They understand that trading is a long-term game and focus on consistent profitability rather than chasing short-term gains, right? So you should always know that it's a long game. You can't just play it like a short game, like you want to make 10k today and run with the profits. You come consistently, short profits until they build up, right? So it's a long game. It's not a short game where you just make 2k or 5k in a day and then you're like, okay, I'm gonna make 5k again. Maybe if your account can really like tackle that kind of targets, then it's fine, right? So it's all based on your risk to reward and how much are you risking per trade, right? So discipline and patience. The third thing is that they have knowledge and expertise, right? Successful traders have a deep understanding of financial markets, including economic indicators, market trends, technical analysis, and the factors that influence asset prices. They continuously seek knowledge, stay updated on the relevant news and developments, right? So you must always like stay within the news, or stay within everything that happens in the market, right? You should always be how can I explain it? You should always be updated by the relevant things that happen within the market. Like looking at the economic calendar might even help you, because there might be some things or some events that are happening or some news releases that are happening within the day that might affect your trades, right? The fourth thing is self-awareness. Successful traders have a strong sense of self-awareness. They understand their strengths, weaknesses, and biases. They capitalize on their strengths, work on improving their weaknesses. They are honest with themselves and avoid overconfidence and ego-driven decision making, right? So this actually speaks with me, guys, because during these past weeks, these past trading weeks, I've been really reflecting on how I can improve my trading and really tackle the market. I've been reflecting on how really I can I can become a better trader, right? And I really recognized my weaknesses, okay, where I have my strengths, okay, what to trade, what not to trade, how not to trade, right? So sometimes it's all about really being aware as a trader how you are, what influences you, and really, like, let's say the type of things that you trade. Maybe if you trade currency pairs, maybe if you trade indexes, like it's different, but you should always be like self-aware, like of your strengths and your weaknesses. That's very important, so that you can really approach the market after you've really recognized them, and then you can, like, approach the market confidently, and you can approach the market knowing what are your strengths and weaknesses, right? So the fifth thing is planning and organization, right? Successful traders have a well-defined trading plan and stick to it. They set clear goals, establish trading rules, and develop a systematic approach to execute their strategies. They maintain meticulous records of their trades, review performance regularly, and make adjustments as needed. This is what you need for self-awareness, to plan and organize your trades, and really look into what influences your decisions, and really what are the things that you're comfortable trading with, those type of things. So you should always be ahead, you should always plan ahead, right? And then the sixth thing is resilience and perseverance. Trading can be a challenging and demanding endeavor. Successful traders possess resilience and perseverance, allowing them to bounce back from losses and stay committed to their goals. They view setbacks as a learning opportunity rather than failures, and maintain a long-term perspective. A long-term perspective, guys. Short gains, it all builds up. I read about this chapter in The Psychology of Money, this book by Morgan Housel. It was talking about compounding, like how Warren Buffett possessed, or how Warren Buffett got his millions, or is the Warren Buffett that we know today. Like, how did he become so successful, right? It's all about compounding. Like, your wins will compound, short, until they become something very, very big. So you should always have that type of mindset, that long-term perspective, that you know what, you should just go short until you get to where you want to be. So all of those things will compound eventually. Do not try to take everything in one step, right? So that's the end of characteristics of a successful trader, right? And then the next thing we're going to do, I think this is the last thing, is preparing and strategizing. This is the last chapter. So the first thing is selecting the right pairs, right? Selecting the right pairs. You need to select the right pairs that work for you and strategy you use. Most people, all traders make the mistake of trading every currency pair and every index that crosses their way. This will only result in losses. You need to backtest every currency pair you trade, so that you know how the market moves and where to execute your trades. Familiarize yourself with the fundamental of every currency, or of every currency pair you trade, right? So the second thing is that selecting the right time frame. Selecting the right time frame is crucial in forex trading, as it can significantly impact your trading strategy, decision making progress, and overall trading performance. Different strategies work based on specific time frames, right? So you really need to, like, check or really back test what time frame are you comfortable trading with, and what time frame your strategy works best, right? What time frame can you really maneuver the currency pair or the index that you trade, right? For example, day trading strategies are commonly used on shorter time frames like minute or hours, while swing trading strategies may be better suited for daily or weekly time frames. By aligning your trading strategy with the chosen time frame, you increase the chances of executing trades that fit your trading style and objectives, right? The third thing is develop a trading plan. Create a comprehensive trading plan that outlines your trading approach, strategies, and rules. Your plan should include entry and exit criteria, position sizing, risk management techniques, and guidelines for adapting to changing market conditions. Stick to your plan and avoid making impulsive decisions based on emotions, right? The next thing is that set clear goals. Define your trading goals, whether they are short term or long term. Determine your risk tolerance, profit targets, and the amount of capital you are willing to risk in each trade. Setting clear goals helps you stay focused and make informed trading decisions, right? So these are the things you need in order to prepare and strategize. The first thing, selecting the right pairs, selecting the right time frame, develop a trading plan, and set clear goals, right? Developing and implementing a trading strategy is crucial for success in forex trading. A trading strategy outlines a set of rules and guidelines that dictate exit and entry and exit points, risk reward ratios, and trading management techniques. You should choose a strategy that aligns with your trading style and risk appetite, while also adapting to changing market conditions, guys. Furthermore, consistent back testing and forward testing of trading strategies can help traders validate their effectiveness and make necessary adjustments, guys. So, guys, this is the end of how to master market psychology, right? I hope you understood. If there's any questions, just comment any questions down on the comment bar, and then I'll be with you there, right? So if you want this PDF, guys, you know what to do. Just go to the Instagram bio, press on the link tree link, go to the website, and then go to the prices and see the prices for everything, like the mentorships, the signals, and this PDF, right? Because there's a lot going on this PDF, guys. This is great stuff. Market psychology, SMC basics, supply and demand, the price cycles, so if you want this PDF, guys, just hit me up. And then I hope you enjoyed the video. I hope you understood. If there's something you don't understand, you can just go back in the video or ask a question, guys. So yeah, guys, I hope you enjoyed the video. I'll see you in the next video, guys. Thank you so much.